So I'd like to introduce Gerry Frittmann from TCF Services. Gerry's the Managing Director of TCF, and since launching TCF in 1991, which is about
24 years.
It's 24. Is it coming up on anniversary next
year? Yeah.
Wow. Gerry's overseen the delivery of over 2 billion, like that wasn't a million, that was 2 billion in government grants and tax incentives for Australian companies. And so obviously he's got a lot of experience in delivering assistance across a whole range of different sectors: software, digital technology, automotive, food, and so on and so forth. Gerry leads an exceptional team of consultants. I've had the pleasure of speaking to some of them over the last couple of years, and I was very happy when Gerry said yes when we reached out to him a few months ago and said, "Do you want to come and speak at this event here?" Because we just in the last 2 weeks I think we sent you 2 large cases over, and I know they always come back and say, "Oh, that's great, we got some great help and we're on the rock and roll." So without further ado, I'll hand over the microphone to Gerry and hope to give him all welcome.
Good morning, everybody. Thanks for the introduction, Mike. As Mike explained, we've got a boutique consulting firm where we've been helping companies access government grants and different types of incentive programs for almost 25 years. The grant landscape changes every 5 or 10 years, so I'm going to give you the most current, up-to-date run-through programs. If you're developing new products, you're wanting to commercialise those products, and you're wanting to export those products. In addition to that, we've started a unique service whereby you can use the resultant grant payment, which will happen in the future time, as security to raise a prepayment. So you can use it to get funding as you go, rather than waiting the following year to receive the funding from the government. Because some of the programs are, like the R&D tax incentive and the EMDG scheme, are entitlement programs. So if you're actually undertaking the activities that are eligible activities with eligible expenditure, you're entitled to the grant or tax incentive reimbursement, which means that you can effectively use it as a security to receive a drawdown, like factoring it if you like, as you go, rather than waiting a year to get it. So I'm going to take you through today quickly the 3 programs that dovetail into each other as you progress through the stages of developing a product and commercialising the product and wanting to fund the commercialisation of that, and how you can use the prepayment service to lengthen your runway as well. So I'm going to start with the R&D tax incentive. So imagine that in the room today, the reason why you're here is because you're either a startup and you want to know how you can get access to government funding, or you're already a company that's in business that's developing new products and wanting to commercialise them. And you want to know a little bit more about how these programs work and what you need to do to make yourself eligible or ready to be able to make a claim. So the first program I'm just going to run you through is the R&D tax incentive. If anybody hasn't got a brochure, we've got all of this available in hard copy to take away as well. So, what is the R&D tax incentive? It's the federal government's main industry assistance program that delivers about $2 billion a year to companies across all industry sectors. So as long as you're eligible to make claims, you're eligible to receive a benefit. What constitutes eligibility? What they call is a core R&D activity, which means experimental activities for the purposes of on a technical or scientific level. So that, in other words, you're developing something that has got some financial risk associated to technical risk. If you're getting paid to do the R&D, you can't claim it. You've got to be undertaking financial risk associated with technical risk. And you've got to be undertaking experimental activities to be eligible in the first place for the purposes of generating new knowledge in the form of products, processes, services or devices. What sort of return can I get? Okay, there's 3 types of returns. If you're a startup or you're a company in tax loss, you can get 45 cents in the dollar. You need the equivalent amount of tax losses to match the R&D expenditure. You cash out those tax losses and the government gives you the 30-cent tax rate up front by cashing them out, so it's a timing difference, plus the 15-cent benefit that you get, which is inherent in the program. So let me just preface that by saying there's two types of benefits: a refundable tax offset if you're under 20 million in turnover, and a non-refundable tax offset if you're over 20 million. So it's the small companies and the large companies. I imagine in the room we've mainly got people that'll be under 20 million, so I'm going to focus more on that side of it. And like I said, if you're in tax loss or you're a startup spending money, you're going to get 45 cents on the dollar back in cash. If you're in profit, you're going to get 15 cents. If you're over 20 million, you don't get a refundable tax offset. In other words, this refund comes back in cash from the ATO after netting off any tax payments that you may have. But the guys that are over 20 million, they get a 10% tax offset, which can only be used to reduce tax payable when they're in profit. That's why companies that are over 20 million, if they do have lots of tax losses, they generally don't claim, because all they're doing is adding to their tax losses. So that's, so is that all clear so far? Okay, there's 4 pillars of eligibility. Eligible entity, eligible project activities, eligible expenditure that relates to the activities, and of course the substantiation you need to cover off any audits. An eligible entity under the R&D tax incentive is an incorporated company in Australia. It's a Pty Ltd or an Ltd. If you're a trust, a sole trader, a partnership, you can't make a claim, or an individual either. So you've got to set up a company, inject some funds into it, start undertaking the R&D activities, start spending money on those activities, and then obviously record it, what the conduct of the R&D activities as you go, using the scientific method. In other words, with the point of view of having a hypothesis and recording the conduct of your R&D, what worked, what didn't work, etc. And at the end of the year, through the tax system, there's a 2-stage claim process where you need to register the project by writing up a technical project description, lodging that with Oz Industry. They then process that and give it a registration number. That registration number is then put on what's called the R&D tax schedule, which is the calculation of the numbers, which get imputed into the tax return of the company, lodged with the ATO, and that generates a refund in cash if you're getting 45 cents, in cash for 15 cents as well, after paying off any taxes that are owed if you're in profit. And like I said, if you're getting the 10 cents, it's just an offset against your tax bill. So there's the 4 pillars of eligibility. So now what I've done here is that I've written down the common mistakes made by tech founders or inventors when they're starting a business, and even companies that are already trading that I meet every day. The notion generally is when you're doing R&D, you try to minimise the spend. You try to do it on the smell of an oily rag, because generally you don't have enough money to do so, or you want to restrict or limit the amount of funds that are going out, because it is financial risk associated with technical risk. So we find things happening like founders don't pay themselves. They do sweat for equity deals. Accountants tell them to capitalise their R&D to show that they've got no losses on the books, it's all been capitalised to give the R&D some value. Well, all of those things are great in theory, but they don't give rise to a benefit. So, as an example, if you're a startup and you don't have any income elsewhere, you've left your job, you're eligible to claim under R&D, you're doing a tech build. What you can decide to do is pay yourself a wage at a lower tax rate, maybe $60,000, $80,000 a year. Pay the tax and the super. It's up to you. You can loan the net proceeds back to the company. You've paid about 20% in tax and you've got 45 cents back on the gross wage plus the super. So there's different ways of funding yourself, if you like, or having, doing things in a certain way whereby the government will provide you with the funding. There's no reason why you shouldn't be paying yourself to put some value to the time you've spent on it. And there's no reason why you can't loan the net proceeds back to your own company and claiming the difference. There's a benefit there. So suddenly the government's now helping out with the costs of claiming R&D. The same as if you sweat for equity. I see it all the time. People say, oh well, there's a 30 grand bill to do a tech build, and we've done a deal where we're going to give the guy 10% of the company. We'll pay the 30 grand out and get him to use the 30 grand to buy the 10%. Suddenly you can claim 45% of the 30 grand spent on the tech build. Again, you're now restructuring it in such a way where the government's helping you along the way. The other way, by minimising costs and giving away equity, you've got no claim to make. You've got no expenditure. You've got to have a minimum of 20 grand's worth of expenditure each year to make a claim in the first place. And that first 20 grand is also eligible expenditure. The other trick is when people go out and do a capital raise, they often go to high wealth investors. Under the program, if that high wealth investor becomes the majority shareholder of 40% or more, the turnover of your company plus his other companies around the world get aggregated for R&D purposes and could push you over $20 million, which means that you're no longer eligible to get the refundable tax offset. You've got to be careful about that 40% rule. Sorry, I'm just losing my train of thought here. And some of the other tips, the sweat for equity. Now, don't be confused that this program, that R&D means people in white jackets and laboratories. 66% of all of my clients are doing software tech builds. The rest are doing in the engineering space across all sectors, but as we all know, manufacturing and engineering in Australia has been dying for some time, and the new world is all about automation. Everybody's trying to disrupt technologies, and even devices and machines are all built on software these days as well. So that's where the space is heading, as you all know.